Welcome to TimesPro's 103rd Leadership Reviews lecture on a very interesting topic, very curious topic called investing with an impact lens. And to do the honors, we have Komal Sahu, who is joining us from New York. And before I hand over the platform to her, let me have the pleasure of introducing her. She is currently the Chief of Sustainable Finance at AVPN Singapore, and she is a fellow of Institute of Certified Accounts, associate of the Institute of Taxation, and the former HMIT, that is Her Majesty Inspector of Taxes, FT Non-Executive Director Diploma, and also from Wealth Management Institution Certificate for Family Office Advisors. And her specialties include impact investing, sustainability, venture investing, business development, strategic advisory, and finance. Invested in tech startups from Singapore, India, and US, and she has been working with them on their strategy and business development in the region. She is also selected as an ACE mentor by Singapore government, and she has been a judge at various business plan pitches at INSEAD, Nanyang Executive MBA and MBA, Nanyang Master's Program, National Institute of Singapore MBA, NUS Institute of System Sciences, New York State EMBA, etc. Over 20 years of diverse experience working for the UK government, as well as a Big Four consulting and accounting firm specializing in the funds industry with numerous assignments at top-tier banks and insurance companies. And she also has a tax expertise in structuring entities and taking companies and funds to listing on the LSE. After moving to Asia in 2006, she has been given substantial pro bono support to social businesses and charities in the region. And as you can imagine, she comes with a very illustrious social sector background and very, very rare, a breed of professional that you come across. And that is the space that is continuously growing with a lot of HNIs and also the top class firms, family offices also investing in it. And we'll have the pleasure of listening to her and have some very, very formidable actionable insights. Over to you, Komal.
Thank you, TimesPro, for inviting me. I really appreciate the opportunity. I serve as, I've got quite an introduction given by Nagendra already, but I serve as the Chief of Sustainable Finance at AVPN. AVPN, I joined about 4 years ago. AVPN is a members network, and it's constituted of all social investors. And if you think about social investors, it's a cohort of very diverse community with corporates such as Unilever, J&J, with foundations such as Bill and Melinda Gates, Rockefeller Foundation, Ford Foundation, as well as development finance institutions such as the Japanese JICA, or if we think about the financial services sector, we have members such as Citibank, Prudential. So really, and we bring, a lot of multilaterals as well, people like the ADB and AIIB. We work with the UN organizations. So we bring their perspective as social investors in this space. And that's what I'm going to talk to you about. How do you invest with an impact lens? And I wanted to just get an idea of the audience. So I'm going to share my screen. If you just give me a second. Is that sharing well, Nagendra?
Yeah, I think it's getting, now it's absolutely.
Perfectly. Okay, thank you. So I'm going to start off by getting an idea of the audience that we have today. I just have a few questions, and perhaps you could respond in the chat. How many of you are familiar with the concept of investing with an impact lens? And please put in your answer 1A, 1B, or 1C. And which area of impact is most appealing to you? So impact is focused on thematics. So you could be interested in climate change, and hence environmental outcomes are important. You could be interested in how do you do community development, or education is the key thing of achieving societal growth and development growth. Perhaps education is important to you. And in your decision-making, whether it's you personally investing or you investing on behalf of your entity, do financial returns always take precedence over environmental impact? So again, if you could please answer. I'm curious as to who the audience is. So if you could number it, for example, Tarun's put in C, if you could just say 1C, if you look at these question numbers, yeah. We're just going to give it 30 seconds for people to respond. From those that have responded, I can see a lot of people are not familiar with the impact investing. So hopefully by the end of this lecture, you will be. Again, what people seem, again, in terms of impact themes, they seem quite diverse. And in your decision making, you seems that the audience is quite evolved. They are interested in a balance between their returns and impact, and it's important to them. So I'm going to give you a history of impact investing. I'll start off with sorry, just the slides. Wow. Yeah, so I'm going to start off with the history of investing with an impact lens. It's the thinking has evolved over the years, but actually has its history in 18th century roots, where basically folks decided that, investors decided that they wanted to avoid sin stocks based on their religious beliefs. And the way this lecture is going to go is I'll give you a history, I'll talk about the Sustainable Development Goals, I'll talk you through what is this investing with an impact lens, which sectors can you invest in. If you were thinking of, if the time permits, we'll talk about structuring a fund, an impact investing fund, and then I will lead you through to talk about some case studies where we've seen interesting developments, not just in India alone, but globally in impact investing, because people say, oh, you know, what are the success stories? So I want to share some of those success stories with you as well. So if we go back to the history, it has its 18th century roots where, you know, and primarily driven by religious beliefs, that you started avoiding certain investments that were based on sin stocks. And, you know, Christian groups, ethical foundations came into existence. Christian groups such as the Quakers and Methodists, even including the Muslim groups, played a pivotal role in shaping sustainable investing. For example, in Islamic principles, Muslims, you know, adhere to Sharia law, so they're not interested in investing in prohibited opportunities such as gambling or alcohol. And we've seen this evolution. So religious beliefs got aligned with personal values, and that has led to what is this today's understanding of sustainable investing. Impact investing goes back to early 20th century. The earliest impact fund that was created was in Boston in 1928, and it was focused on profitable ventures while avoiding companies that were involved with controversial activities. We've seen a rise of in socially responsible investing, or SRI, from the 1960s and 70s. And again, investors were involved with considering social and environmental factors in their decision making. And if we think about the spectrum, you know, this whole spectrum of capital, there's the fiduciary, where you think it's about generating profits for your shareholders, financial gains for your shareholders. And then there's the philanthropic, this donating and giving to social and environmental benefits. If we think about investing, it's evolved. It covers that entire continuum now, not just pure philanthropy, but also ESG. We've seen developments in that space. ESG stands for environmental, social, and governance factors. So we've seen this ongoing development, and we've seen in the last decade or so, impact investing really gained traction, aligning the aware and the interconnectedness between financial success, social impact, and environmental sustainability. What I would say is, I think actually the issues we've seen around climate change, the issues that the pandemic led us to, which was, you know, none of us was insulated with what happened during COVID. So I think that learning has really created a momentum for investing with an impact lens. So in, you know, at the turn of the century, this century, there was a main drive to get people above a poverty line. So that poverty line was $1.25. And by, you know, the year 2000, we felt we had already achieved that. And yet it had not resulted in global problems being solved. So the Sustainable Development Goals were adopted by the United Nations, and it became a call to action. It was a universal call to action in 2015, and it was to basically end poverty, protect the planet, and ensure by 2030, enjoy peace and prosperity. And there were 17 Sustainable Development Goals, and they're all integrated. So, if you create decent work, then you have the opportunity to end poverty, you have the opportunity to result in zero hunger. Again, health, inclusion, Sustainable Development Goal and well-being also deals with medical diseases such as, diseases such as AIDS, malaria, and so on. And again, gender equality under Sustainable Development Goal 5 results in greater women in the workforce and generally promotes development. So the creativity, knowledge, technology, financial know-how, that's all necessary from society to achieve these Sustainable Development Goals. And again, the vision is for 2030. We're not that far away from 2030. We're at the halfway point now. And what I would say is, just for Asia Pacific alone, if we want to achieve the Sustainable Development Goals, pre-COVID, we were talking about almost $1.5 trillion per year to achieve these Sustainable Development Goals. And if you think about India's GDP, it's about $3.5 trillion a year. So if we think about what is needed to achieve this just for Asia Pac alone, we're looking at $1.5 trillion per year. And again, but in contrast this, you have a third of the world's billionaires in Asia. You have, ultra high net worth individuals. And I would say the next generation is really leading the case with families. You've seen many cases is to tackle societal issues through investing. And what we are also seeing is that these are, there's a lack of an enabling environment right now to take these leaders, to take this private capital to action. We need to cultivate these impact leaders. We need to stop funding waste. We need to bolster all the funding channels and do capacity building. But we've seen increasingly themes that become important. For example, whether it's nature-based solutions, whether it's animal welfare. We need to go beyond. We need to look at global complex issues. So this was we've seen a growth in impact investing, and this was a very niche domain of impact investing, and it's now increasingly become mainstream. In 2022, the global impact investing market, which was estimated by GIN to be $1.16 trillion, still very small. And 16% of that funding is allocated to East, South, and Southeast Asia. So still, again, I've got this pie chart here showing the types of organizations that GIN surveyed that were investing, and that was used to gather that data. So how does sustainable finance work? There's this idea that we're going to have to forego financial returns in favor of ethical investment, and that's we're seeing is clearly changing. There's an emphasis, the learning of impact investing is you basically do need financial returns, otherwise you can't move the kind of capital you need to and you clearly need to distinguish it from philanthropy, which actually involves giving money away. Here you're actually investing with view to having a financial return as well as a social and environmental return. And how could it work? I mean, we have within corporates CSR, and we know in India, for example, 2% of your net profits are meant to be given towards sustainable, a corporate's CSR activities, and we're seeing the CSR evolving. People are thinking, how can I use it's a large quantum of money? How can this be used differently? How can it be recycled and being used for impact investing? How can investors support sustainable companies? And again, ESG has become de rigueur in many companies. Even before the regulators are enforcing on ESG, companies are committing to creating annual reports where they talk about the impact that their day-to-day business is having. There will be time for questions at the end. So, use your Q&A and chat function to write questions, and I'll try and address as many of them as I can at the end. So how do we optimize this impact and profit? How do we make sure that, there is the three core principles being met with respect to impact investing? So we are seeing that, we will have you need to, firstly, when you think through your impact investing strategy, you need to define what are the outcomes you're hoping for? What are the changes you're hoping for? How are you going to define and measure the impact of what you're going to do? How are you going to shape or influence? And what is your risk threshold? So here, I would again say it's important to look at what is your geographic focus? Are you going to look at developed economies? Are you going to look at developing economies? Are you going to look at local communities? Are you only going to look at your own country and not beyond? You need to think about what your themes are if you're going to be an impact investor. Are you focused? Because you can't do everything. So you can, we see many funds set up focused on healthcare or education or financial inclusion or focused on climate. Are you looking at innovation? Are you going into deep technologies? Or are you thinking about improvement? Which are you prioritizing? Also, what are the investment classes? It all depends on your time horizon as well. Are you looking with an equity lens? Are you going to be investing in stocks and shares? Are you looking with debt? Are you creating a credit vehicle? Are you investing in fixed income? Are you looking at real assets? Are you looking at land? So are you looking at commodities? What is your risk tolerance? What is your risk appetite? And again, what is your impact depth? Do you want to look at the people who are between $1.25 a day to $5? Is that your target segment of beneficiaries, to $5 a day? Are you going to $15 to $20 a day who have the ability to buy your goods and services? So again, you're going to change your impact investment strategy based on where your geographic focus lies, where your thematic focus lies, what is your approach to innovation and improvement, what is your investment class preferences. And a tailored approach, I would say, is the best. Once you've thought this through, then you can figure out what your strategy and goals are, and how are you going to drive the social and environmental improvements. People think of impact investing only in private markets where you can have greater influence. I would say that you can definitely think about, look at the public markets as well as an opportunity to look at how can you pursue social and environmental progress. And public markets are evolving. They must evolve, and they are evolving. What public markets do is they democratize access to impact investing. And I would say why is because to enter into impact funds, the ticket sizes are much larger. The amount you need to invest is much larger. Whereas if you were a retail investor, you could buy a single share or 10 shares of any one company. So there's that democratizing piece of it that's important. And then you have liquidity. If you invest in a closed fund, an impact fund, your funds may be tied up for 5 to 10 years, whereas here you have liquidity, and of course public companies report, so you have transparency as to their performance. But however, VC and private equity, venture capital and private equity obviously can afford to go deeper into various sectors and regions, but you've got this inherent limitations, about reduced scale, limited access, as well as liquidity. Just give me a second. So how can you you say, okay, I'm a very small shareholder in a public market. What can publicly listed company, what can I do, right? You obviously can participate in shareholder resolutions. You can participate in AGMs. You can encourage others, or if you're investing through a fund, ask about what they're doing regarding their engagement. You can encourage better corporate responsibility and sustainability. Public markets are regulated, and over the globe, we are seeing ESG becoming more and more important. Regulators are stepping in to mandate that companies report on their ESG. Even people like in Singapore, the Monetary Authority of Singapore, we're seeing this with the SEC. So I think that there's definitely a global drive to ensure that companies report on their impact performance. And again, with liquidity in the public market space, you can buy and sell. If some company is not meeting your impact obligations, aside from an activist stance, you can also decide to divest. You can decide to sell that company and buy something that does meet your impact goals. And, again, institutional investors go into many public companies as well. And there's a lot of media that can actually help in terms of making sure that the companies adhere to their goals, impact goals. Public image and reputation becomes increasingly important. So why impact investing? So the impact investing is a little bit narrower often because it's looking at private markets. These are entities that are not listed. What I wanted to talk you through was, if you were investing with an impact lens, what are the types of vehicles you could go into? So definitely public markets is one. You can also think about private markets, or if you're deciding to set up your own fund, and I will talk you through some of that as well. So impact investments are investments made with an intention, and that's a key part of it. There has to be an intention to generate positive, measurable social and environmental impact, and alongside a financial return. So again, it goes against the long-held views that there is a compromise to be had between the two. And there's, again, there's opportunities for investors to advance these solutions such that they get financial returns too. So as I said, GIN defines, this is the core characteristics by the Global Impact Investing Network. It defines there has to be an intent to contribute to positive social and environmental impact. You have to have data. So you have to measure your performance, and you have to have data. And that data is not just about financial data, but it's also impact data. And that has to be there from the outset. You also have to make sure that you not just measure your performance, you report on that performance. And then by sharing that performance, by sharing about your learning journey, you actually grow this space. And we're seeing a lot of impact funds come up who are doing this. So if you were thinking, I don't know if the audience, if any of you are thinking about setting up a fund, it's very similar to what you would see in a VC PE fund, but obviously impact is a key consideration. You'll set up a fund where you may be the general partner, your limited partners are the investors that come into the fund. You set up the investment fund, and where you get commitments from these various people who are, and the money goes towards the investment fund. And you have a financial advisor or fund management advisor, as well as an investment committee that sits outside this fund. And the fund in itself invests in its portfolio companies. So when you think about setting up the fund, there's a process. You have to design this fund, and you have, obviously, you secure the capital, but there's a post-investment reporting obligations to your investors. And often these entities have to be regulated, and the fund manager will have to be a licensed entity to be, depending on, again, how it's structured for that to happen. You craft your thesis. It is a investor aligned thesis. Often investors, the first couple of investors who you will engage with, who will be interested, will help you think through your thesis as well. And you keep refining based on your insights. You establish a solid structure. You pick up your team or team that you intend to hire. And again, whatever you do, it has to agree with the investors' expectations. It has to be economically viable. You have to have sound fund economics around it. You do detailed budgeting, and you, again, iterate. You keep iterating based on what you learn from your landscape analysis of the themes you want to invest in. And there's an interdependence between all of it. And then, marketing versus design. Obviously, you will market your fund, but having a well-designed fund is a key for success of the fund. So I would say if you're thinking about a fund, setting up a fund, you have to have an investment thesis. You have to realize what your risk and return profile is going to be. How much risk are you prepared to take? And you source deals. So sometimes even before you launch your fund, you may have thought through which areas you want to invest in. And you may even have met a couple of companies that you're going to invest in, or maybe more than a couple. And so you have to have a pipeline of these entities. You may be interested in investing in something that doesn't even have companies that you can invest in. So that robust pipeline is going to be important for investors when you connect with them. So often your pitch deck for your fund will have the pipeline of entities. And then remember, if it's an impact fund, your impact objectives, what are you trying to achieve? What is your theory of change? What are the outputs and the outcomes you're going to get is going to be a key component of what your investors would be interested in. And then you will often put an investment committee together who will, who you will talk through how you went through your diligence, as well as how you will allocate. They are often help you with the decision making and may well have the veto power on the decision making when it comes to capital allocation. And the timeline to do this could be 24, maybe even more than 2 years. So you design within your first 6 months, you iterate, you speak to your couple of investors, you go to market, and you start announcing your first close, which could be about 12 to 18 months. And hopefully by year 2, end of year 2, you're ready to close your fund and start looking at your portfolio companies. You're going to conduct a due diligence on these potential investee companies. You want to make sure you manage your risk. Additionality is a key component. You have to add value to the company. Could they function without you? Could they raise money from somebody else? That's a key component as an investor you want to think about. Where is my value add to what I'm doing? You screen them for impact, and you make sure that impact is embedded in their thinking as much as it is in yours. They have to report to you the impact that they're creating. So if you think about an education company, how many children is it looking at? K to 12? Is it looking at higher education? How is their gender demographics? What is the teacher training like? All of this is going to be a key part of it. And then you respond to your LP expectations. Basically, you have to gather information. Many times, depending on the size of the fund, you might report once every 6 months, or you might even report quarterly. And then there's post-investment management. You will actually look at how do you manage these companies. Often you will take a board seat on these portfolio companies that you're investing in. You'll they will submit quarterly financial statements to you and their valuations, and then you will then report that back. And you keep continually, as a part of a board seat, as a part of a strategy committee. Sometimes you help them with HR processes. Sometimes you help them think through strategy for their impact investing, to think through the field. You have to, as a fund manager, continue to add value. And if you're not thinking within setting up your fund, but you're thinking with an LP perspective, remember, because these funds are raising tens of millions of dollars, your LP commitment may have to be, LP meaning an investment commitment, investor commitment, may have to be $500,000 or more. So again, this is why public markets is important. You can invest with a single share. Here, when you're coming into impacted funds and investing, the amount you need to invest in each as an investor is much larger. And I would say, again, in this private capital space, additionality as an investor is a key component. How do you add to the business model of, how do you add through additionality through your asset class? For example, if you're looking at the micro, small, medium enterprise sector, and they don't have access to credit, could your providing them with working capital, providing them with long-term debt, had they may not have access to quite the same because they don't have the collateral yet to be able to tap on these loans. Perhaps you, being a credit investor, may be adding additionality through that asset class. This is where we're talking about an asset class. Again, this is, as an investor, you need to think through your additionality. There is, clearly uncertainty. And I would say, there are three options there. You look at, how can I add positive impact to your current investment holdings, without allocating additional capital? Or, many times a fund will be where their investors can be development finance institutions. They may give you a small amount towards technical assistance, which is money they're not expecting back as part of their investment returns. You can capacity build for the entrepreneurs. You can use that money to train them, to look at their financial models, to help them get ready. They may not be ready for your investment yet, but with that technical assistance money that your development finance institutional investor has given you, you can then use that money to help these entities get ready to be investable by you. Or you could sit on the sidelines and say, look, I'm not going to participate. But this is not ideal, because you want to, if you're going to move the market needle forward, you need to figure out whether you can do something actively to support these underlying entities. This is an example of one of our members called Leapfrog. Leapfrog is a growth stage impact investing fund. It has over $1 billion under management. And it has recently raising a climate fund as well. So it used to be focused on healthcare and financial inclusion, both in Asia and in Africa. But now they've raised a climate fund with $500 million worth of funding from Temasek. This is an example of an investee company that they invested in Africa, sub-Saharan South Africa. They're looking at people, how do you provide insurance to people living with HIV, AIDS, and diabetes? If you think about that segment, people think that these individuals have diseases that are incurable, and therefore, they will tap on healthcare insurance on a regular basis. How do you make sure that this segment that is previously underserved is now able to get access to health services? So this was an investment at an early stage. It was a $13.9 million investment, and it tried to also do media around reducing the stigma associated with HIV and AIDS through widespread advertising and insurance accessibility. And if you think about the outcomes, these people may be denied claims here. One of the key metrics is, does insurance deny you claims, right? So the people, because they had this insurance and it was a pre-existing condition, they could now tap on healthcare services that they previously would not have had. So again, their families could benefit. If you think about the longer term outcomes, these people can work. They have access to medication. This is really a holistic, a deep, with a large amount of capital, really a deep dive. People often think, oh, if I'm giving it the different segment large amounts of capital, I'm not going to have impact at the smaller levels. But actually you're changing really outcomes at scale. So how do I measure my impact? Now, this is clearly becoming a deep, important topic as we see impact funds coming into existence, organizations starting to think with an impact lens. So Impact Measurement Project has brought together 2,000 practitioners to understand the fundamentals of impact measurement and management. And from enterprises of all kinds, from asset managers, from owners of wealth And they look at 5 dimensions of impact. So understanding what, who, how much, the contribution, as well as the risk of my work. So if you think about what is the specific outcomes this enterprise is seeking to achieve? So how do I, for example, it could be improving access to education, promoting renewable energy, increasing financial inclusion. How am I achieving that? What is this entity? Who is our target population? Who are the stakeholders who are going to be benefiting from this enterprise's effort? And then if you think about how much, so what is the addressable market size? What is the impact I'm going to be able to have at scale? What is the depth? What is the duration of the impact I'm going to have? And what is the degree of change that's going to be experienced by the beneficiaries of this entity? What kind of contribution am I going to make? And that is your decision as what is your additionality, that question. And then what are the potential risks and uncertainties? But I would also say that, people only talk about positive impact. Sometimes you could be doing something positive that actually think you're doing something positive that could actually have a negative impact. And so are you considering all of the externalities? Are you holistic in your thinking? When you're thinking about the risks involved with. So yeah, again, there were various phases at this in order to create this 4-stage IMM cycle, and there was at various stages you compared heterogeneous outcomes and heterogeneous entities. So and you came to a consensus of what was important. So this is also part of what Jin has launched, which is called Iris Plus. If you can actually click on Iris Plus, and there's a whole host of sectors that you could click on that will tell you what are the key metrics that you need to capture for each stage of the outcomes. So there is an ability to understand what are the core metrics, and it's completely aligned with what IMP did on the 5 dimensions. I know I want to allow time for questions and answers, so I'm going to make sure that I might speed a little bit up. So these are case studies. We have at AVPN something called a deal share platform, where we have social purpose organizations listed. So many of our family offices or investors can actually look at these entities and decide that this is something they want to invest in. And the investment doesn't necessarily need to be financial capital. It could be human capital. It could be intellectual capital. So, they can come in and mentor. They can share their landscape studies or whatever work they've done. So Reach 52 is a healthcare entity. It says that 52% of the world does not have proper access to healthcare. So if you think about what Reach 52 did and does, is it's looking at how do you get healthcare workers to where they need to go? How do you ensure people have access to education, diagnostics, medicines, vaccines? And this is basically, COVID exacerbated children's vaccines, for example. They were not unable to get access to children's because everything was focused on ensuring that the COVID vaccine was delivered. So as soon as some of the preliminary vaccines started to be given for COVID, they started health campaigns and ensuring that children had polio vaccines and so on that were not available during the time. So they made sure that, and they try and reach into the hinterland, into the villages, into their communities, and look at whether healthcare workers could work with them. And they had through us, they were connected with our corporate member. That's another thing we do. We enable collaboration. J&J was able to work with them to make sure that some of the vaccines that needed to be delivered could be delivered in Philippines. And now I think they've recently started working in India as well. Education is an edtech entity in Philippines. Often children who finish high school have no idea what they want to do. They don't, I mean, I can imagine myself as a high schooler who had no idea what I wanted to do next. And you basically learn through whatever other people in your college were doing or other people in your school were going to go and do what you wanted to study. This enables people to actually have online access, because many cases, some of these kids have, are probably the first time cohort that's graduated out of high school. And, they don't have the parental mentoring that many of our children will do. They don't have peer groups they can tap on. So they can go onto an online platform which can guide them through what careers might make sense for them. Are there scholarships they can tap into that can help them go to university in the Philippines or even apply overseas, and basically gives access to career guidance for anyone irrespective of their social status. Basics Krishi is an entity that has been funded by another member of ours called Acumen. And Acumen is looking at, if you think about India, nearly 85% of India's 100 million farms is less than 2 hectares. So they're smallholder farmers, right? And they should have access to, just give me 1 second. Yeah, so these are smallholder farmers that should have access to services that they don't do, looking at things like how is their soil doing, vets, looking at artificial insemination and scientific analysis of soil nutrients, and often you need in-person contact for them. So what this entity, Basics Krishi, does is it has agricultural experts who have postgraduate degrees in agriculture and veterinary sciences. You may have extension services providers such as fodder management, deworming, soil testing, training for pest management. And this could be online through a mobile phone app, or it could be a visit in person. And the farmer pays a small subscription fee to get access to this. And of course, we have success stories such as Fab India. Now, that is one of the largest success stories we've seen. In colonial India, Indian artisans weren't properly recognized, and in post-independence, they found difficult to get an appropriate marketing outlet for their work. So things had changed, right? So in 1960s, there was an American gentleman called John Bissell who realized this untapped potential of Indian handicrafts. So he set up this entity called Fab India. Today, it employs about 2,000 people overall, including contract workers. It gives men and women equal opportunities, same career chances. It buys goods from craftspeople and also makes the artists actually stockholders. So they're looking at their long-term outcomes for these artisans as well. And if they, for example, sometimes they provide products that are not subpar, they're not returned back. So the artisan doesn't suffer, but is continually guided to improve his outputs. And I think now we've seen, the products and services were so interesting that LVMH, Louis Vuitton Moet Hennessy, has a private capital arm called El Catterton, and El Catterton invested in Fab India. Now, Fab India is in 327 locations in 118 cities, and it's also now in countries abroad, including Singapore, that we've seen, they've multiple stores opened up. And again, this allowed an opportunity to really take this company and grow it. And again, it's based on this. A similar entity in the US and it's a listed entity called Etsy that exists, that allows artisans and to sell their crafted and vintage goods. It provides a marketplace for that. It's an e-commerce entity, and we've seen again with the growth of e-commerce, why should there not be e-commerce opportunities for micro entrepreneurs. We talked about multiple segments. You can even invest in real estate, which are green, which have, again, which have decent work and economic growth. You can look at, so there's opportunities even within other sectors, where there's a greater consideration on sustainable cities and communities. There's a greater consideration on climate action. It's how the developer works with their workforce that may be of interest to you, that there's decent work and economic growth for the often you'll see developers treat their workforce quite badly. There's not accommodation. There's not safety equipment provided. Once you see that kind of transition, you say, okay, actually, I can have an impact. If I'm investing in real estate, I could actually invest in somebody who cares, who's doing all of this to make sure that the real estate that you're investing in has impact. So each decision that you make has impact. That's the key component of it. Again, in commodities, should I actually be investing in certain commodities just for my portfolio diversification? How do I protect myself against inflation? Can the commodities that I invest in have positive social and environmental impact? You can also invest in fixed income. There's a whole host of green bonds that have come into existence. There's social bonds. We're also seeing in the US certain ESG related impact bonds that have. So there's against the whole host of continuum of capital and asset classes is there for you. Who are we? As I said, we are a 600 member network. Plus 600 plus member network. We're global. We have members from across the globe. We are physically present in 13 different markets. And our role, what is our role? Why am I here today? We see ourselves as ecosystem builders. We want to our mission is to move capital towards impact. And that includes human capital. That includes educating people like you, who are interested in this space. And we have evangelists for the whole theme of investing with an impact lens. I think we have a little time for questions. I will stop short here, and I will ask. I have the ability to ask you questions, but you also have the ability to ask me questions. So, and again, I'm happy to take any questions at this stage.
Thank you, Komal. I think we have a few questions. With your permission, can I start?
Yeah, I'm going to stop sharing.
There's a question from Mr. Tushar Parekh. His question is, curious to know what is your assessment on the effects and risk on domestic and foreign impact investments considering socio-economic changes over a period of time. If we consider a diversity-rich and a developing economy country like India as a use case. Thank you, Tushar.
Tushar, I would say that a lot of the impact investors that are coming, and they're coming with an impact lens, they understand the economics on the ground are driven by domestic needs and domestic consideration. They're not coming, I mean, I know the fear is, oh, they're coming in from overseas, they're coming in with a colonial mindset. That is not true. They are coming in with a development mindset. They're coming, so that's the distinction you draw between normal capital and impact investment capital. And I think their intention is to come and develop the economy. The intention is to make sure that the underserved, those that do not have access to various products and services that are necessary for economic growth, have so. So I think there is diversity. They want to protect that diversity, and they want to work with or give capital with the way that impact is a key consideration. Hopefully that's answered your question.
Now, Mr. Vinay Novel has got 3 questions, Komal. Mm-hmm. And the first question is, kindly share on how to raise awareness on ESG in public domain. That's the first one. The second one is, how can we fast track IPO of NGO with profit purpose? And his last question is, why your presence is quite low in developed countries. That's about AVPN, Komal.
Oh, okay. I would say that firstly, when we think about how do we raise ESG awareness, I think the drive has actually come from the European Union. The most regulations we've seen have been from the European Union. Asia is a slower adopter, but I think governments, with considering what happened during the course of the G20, what has happened during the Conference of Parties in Dubai, I think those conversations are educating, and we see the topic of ESG, the topic of impact become increasingly important at the government dialogue level. You need ministers working with ministries, the bureaucrats, you need the advocacy piece to be very important, and where everybody, including media, has a role to play to raise awareness of ESG. And I think the regulators, there is inevitably, as you go and try and raise capital in public markets globally, you're going to see there's going to be an increasing need to show your ESG performance. So if you are going out there to raise capital, ESG, and remember, ESG is not just environmental, social, it's also your governance, right? So the governance piece of it is critical if an investor is going to come into your business. So I think we are going to see people like SEBI and so on talk about how ESG reporting is to be done. Even all of, in Hong Kong and Singapore, you've seen the regulators say, okay, show us your ESG compliance and explain. That's how they started out. Either show us your ESG compliance or explain why you don't comply. And then subsequently, they made sure that ESG reports came into existence. Companies had to give ESG reports. And I think that's the transition we're going to see in India as well. How do we fast track IPOs? I think there is a social stock exchange that has been created in India, but it is only looking at NGOs and not NGOs with a profit. It's looking at NGOs to raise money on the social stock exchange. Robust entities who meet certain NGOs that meet certain criteria can actually tap on money. But NGOs with a profit purpose, I think it's like any business. You're going to have to show your business metrics. You're going to have to show your financial performance. You're going to have to, what impact investors realize is no different than any other business. If you have to meet certain metrics to get to the IPO stage. Similarly, with impact entities, impact enterprises, you're going to have. So how does a Etsy get listed? Because it meets certain financial metrics. You can't compromise those at the expense of saying, oh, I should be fast tracked. No, because at the end of the day, an IPO process has to protect the retail investor who has the ability to buy that listed stock. And the next question.
His last question was why your presence is quite low in developed countries. That's a AVPN, I believe. Yeah.
So who are we? We are looking at mobilizing capital for Asia. So we have members we obviously want to bring domestic capital providers, but we also want to bring international capital providers. Why do we have lower presence in, yes, we have Unilever, we considered, or Citibank, they're members out of Singapore, but they're not, so therefore we consider them as Asian members, but actually they're not Asian members, they're global members. So in that way, firstly, I would say our presence with global entities is large. So whilst they're not categorized as coming out of the US, many of them are US entities or European entities. I would also say we are growing. We previously had our team concentrated in Asia. Now I'm based in New York. I have a team member in Europe. I have a team member in London. So we're going to definitely see growth in these markets and bring more members to that. So yeah, that's the reasoning why.
This is a question from Mr. Tarun Yadav, maybe the second last question for today evening, Komal. His question is, how can we bring mental health awareness towards rural society as a product for business? Thank you, Tarun.
So actually, it's very interesting. Yesterday, there's been a UN-led event happening in New York for 2 weeks focused on gender. And one of the presenters yesterday who I met spoke about how depression in women is one of the key reasons we don't see success in rural communities. Women who are depressed are not going to be great in the workforce. They're not going to be great in terms of caregiving. They're not going to be great in terms of relationships. So, and the impact that has on productivity as global economic development, global is incredible. The stats he gave in the countries that he works in Africa is like 25% of women have depression. So and if you were to lift them out of depression and you were to empower them, the difference it could make from a development point of view could run into trillions. So I think you are absolutely right that if we can create mental health awareness in rural society as a product for business, we could see substantial contribution to GDP. Because as I said, and the next generation, women are often caregivers as well. The next generation will have really positive outcomes. It could change the landscape. And that was an eye-opener for me. So I think, yes, Tarun, you're absolutely thinking along the right lines.
And the last question again from Mr. Vinay Novel, Komal, is how to make mandatory publication on ESG as the first page of public information published by the private or government-owned company. Thank you, Vinay.
So what you will often see is when you look at public reports, it'll be an executive summary on the first page where the chair or the CEO of the company signs off. Increasingly, sentences around their ESG and their impact performance are making their way into the first page. So the mandatory publication of ESG is a report that is going to become, there's something called the International Sustainability Standards Board that defines, is working with the Accounting Standards Board to say how should companies report. So they've introduced something called the financial report. I'm an accountant, so sorry to bore you with this. They've issued Standard 1 and Standard 2. Globally, that standard, if you're going to be using accounting standards to put your accounts together, globally that standard will be adopted. And I think we will see greater and greater reporting on impact performance and thinking along on each line of your accounts to be thinking through sustainability. So I think that is it'll go beyond ESG. It'll actually become standard in your accounting requirements. So it's worth looking at the ISSB's reporting standard 1 and reporting standard 2, and companies who are submitting global level accounts are going to have to adopt those standards. And I wouldn't be surprised if the Chartered Accountancy of India also starts looking at what those standards are.
Thank you so much, Komal. I think it's an absolute pleasure and quite a depthful topic. I think the canvas that you presented and the kind of the coverage that we had in the last about 1 hour is a phenomenal. I'm sure all the participants must be going out with great insights. Thank you once again from all of us and joining us from New York, especially in the morning, and on a Saturday morning, especially. Thank you so much from all of us.
Really appreciate it. And thank you for inviting me. And I'm glad, as I said, if we can move the needle even ever so little with human capital, we've done our job. Thank you.
Sure you would.
Bye-bye.
Thank you so much.